All right. Hey, everybody. Rob Maurer here. Today we are joined live by analyst Gordon Johnson, founder and CEO of GLJ Research. Gordon currently has a $19 price target on Tesla, which is, to my knowledge, the most bearish price target on Wall Street. So today we just wanted to have a conversation about our differing points of view on the company. So this is live, but we'll be focused on the discussion rather than the comments. But as always, please keep those respectful, even if you do disagree. So Gordon, thanks for joining us. A lot of listeners have requested this, so I was definitely glad that you reached out and happy to have some time today to talk about Tesla. Do you just want to start by giving us a little bit of background on sort of how long you've been covering Tesla and how that came to be?
Yeah, sure. So I've been covering Tesla for roughly 2 years. The reason why I started covering Tesla is because I felt like the company was overvalued. So that's how long we've been covering it, and that's how it came to be.
Okay. And then was that, because I think you covered Solar City originally, right? And then sort of shifted over to Tesla? Am I remembering that correctly?
Yeah, no. So we covered Solar City. We thought it was headed to zero. And as you know, Tesla stepped in and purchased it. At the time, I think Solar City was doing roughly 200 to 300 megawatts per quarter in cells. And in the most recent quarter, I think they did just over 20 megawatts, Tesla. So clearly it hasn't been a great success. But no, we didn't flip that to Tesla. It was about a year or two later that we picked up coverage of Tesla.
Sorry, you cut out there for me. What was the last part?
It was about a year or two later that we picked up coverage of Tesla after Tesla acquired Solar City. So we didn't flip Solar City to Tesla.
Okay. And consistently throughout that whole time, you've been bearish. I think you've recommended a short on the company sort of since then. Is that correct?
Yes, that is correct.
Okay, got it. So I guess we can start off, just sort of give us your general, bear thesis, maybe even starting from the beginning or where we're at today.
Yeah, sure. So it's pretty simple. We see Tesla as a busted growth story. Their U.S. revenues peaked in the fourth quarter. Their global revenues peaked effectively in the fourth quarter. The fourth quarter of 2018. So U.S. revenues peaked in the fourth quarter of 2018. Global revenues essentially peaked in the fourth quarter of 18. Their auto gross margins peaked in the third quarter of 18, and yet the company's being valued at tremendous growth. And barring what they're going to do in the third quarter, effectively you had a peak in their deliveries also in the fourth quarter of 2019. So the company is not growing. That's number one. Number two is if you look at their market share in Europe, which is the most highly competitive EV market in the world, their market share in Europe essentially went from roughly 35% in the fourth quarter of last year to single digits as of right now. So they've lost considerable market share in Europe. And if you consider their technology, I think there's a lot of misconceptions and quite frankly, mistruths out there. Tesla does not make its own batteries. It never has. They buy batteries from Panasonic, LG, and CATL. And anybody can buy the batteries, the battery technology that Tesla uses. So they don't have any advantage there. There's no moat there. And CATL already said they're going to have a 1,000,000-mile battery. I think GM announced a deal with LG Chem, and anybody can buy batteries from Panasonic. And then if you look at FSD, full self-drive, we believe that's vaporware, i.e. it doesn't exist. And Navigate ranks Tesla dead last in FSD technology. Forgetting about the stock price for a second, if you just look at the fundamentals, they're losing significant share in Europe, right? And I didn't mention China. In China, it looks like their sales of Model 3s came in at about 11.5 thousand cars in August. They should be producing, based on their comments, over 20,000 cars and selling over 20,000 cars a quarter because they went into August with about 4.5 thousand cars of inventory in China. So if that's a preliminary number, but if the number does come in at 11.5 thousand cars, or quite frankly, anything less than 20,000, that's a huge disappointment. So things aren't going well in China. And then if you look at the USA,
sorry, I got to interrupt on that point. Yeah, so in China, 20,000 per month, you're saying? Because that'd be about 240,000 a year.
Right. So in their Q2 release, they said that their capacity in China was 200,000 cars a year. So just using that number, it should be about 16,667 cars per month that they're making. But they said they're ramping up capacity. So based on the capacity announcements they've made after that, they should be selling around 20,000 cars per month in China. And to say that one of the arguments is, well, if they produce 20,000, they can't sell all that 20,000 in that same month. We agree with that, but they had inventory going into August, 4,500 roughly cars of inventory. So indeed, they should have sold 20,000. So if the number comes in at 11.5, they're operating at roughly half their capacity. So that would be a huge disappointment. And as you know, there's a lot of competition coming in China, coming after Tesla's next. So our point is, look, we know the stock price is high, and I think a lot of people use that individual dynamic to justify their bullishness. But if you look at the fundamentals and you look at the numbers, they're getting incrementally worse, not better. And one other thing that's important, if you look at the ro-ro boat loadings for Tesla in San Francisco, their last record quarter, 112,000 cars shipped in the fourth quarter of 19, they loaded roughly 17 boats. This time, I think it's 12. And the days the time they spent loading is down 38% in this quarter versus last quarter. So by every indication, deliveries this quarter are going to be tough. It's going to be tough for deliveries this quarter to beat the record they set in the fourth quarter of 19. So again, this company is valued at nearly a valuation that equals nearly every single automotive company combined in the world. So theoretically, based on Tesla's valuation, in about 5 years, every car you see outside should be a Tesla. So if you don't see tremendous growth in their fundamentals, we think the stock's going to I think you're going to start to see that in the third quarter and the fourth quarter. Keep in mind, excluding credit revenues, right? This is essentially taxpayer money that Tesla's been given, and they're going out and selling credits to car companies who aren't making EVs. In the last 32 quarters, only 4 of those quarters have they been profitable, the most recent of which was 3Q19. So that essentially disappears next year because every automotive company is now making EVs. So if Tesla can't sell those credits, they're going to have to go back to reporting financials and fundamentals based on their core auto business. And their core auto business is burning a significant amount of cash. Excluding credit sales in the second quarter, they burned $300 million in cash. They lost $300 million
on the
in
GAAP
income
profit line, but not necessarily free cash flow.
Well, how do you define free cash flow?
Well, GAAP profit includes stock-based compensation, which is obviously a non-cash cost. So I think a better, if you're going to say they're burning cash, you should probably be talking about the actual cash flow line, right?
Well, no. So if you look at Tesla's free cash flow, the way they define it, answer me this. How does their operating expense stay the same despite having a new facility in Shanghai? How is that possible? How can your expenses be the same despite having a brand new facility? Even if you had significant amounts of, advances in costs, you're going to have higher costs. Their costs are actually declining despite having a brand new facility. So I believe that when you talk about free cash flow, I believe they're capitalizing a lot of items on their balance sheet which aren't making it to the cash flow statement.
Okay. Yeah, I mean, that's a fair point of view. I think one of the bull cases on Tesla is that they have been generating a lot of operating leverage over the years. I think previously they were running at a point where the operating expenses were pretty high. They had room to come down in selling general and administrative costs. They've done that. They had room to come down in R&D, or at least hold that steady as revenues have increased. So I think if you look at the operating margins that Tesla has generated and the operating leverage, it's scaled significantly. Operating expenses are up 80% the last 3 years versus revenue almost has tripled, or even more than tripled, up about 250%. So I think that's, when we're talking about the fundamentals, and you've made a lot of points here that I want to come back to, a lot of them, and have a more robust discussion about all of them. I want to give you the opportunity to present your case first. But I think if we talk about the operating leverage, that's something that has improved dramatically for Tesla over the years. And you could say, okay, maybe they're hiding some costs in there. Or if you want to take a more bullish perspective on that, I think you could view that as a good thing, that Tesla has found ways to grow revenue while cutting costs.
Right. But what I would say is, that's my point, right? They have a brand new multi-billion-dollar facility in Shanghai, right? So no matter how many gains they made on operating leverage, if you have a new facility, you're going to have a significant increase in expenses, and their expenses are actually falling. So my point is, where are the costs associated with Shanghai, right? So, it's impossible to have 100% operating leverage. If there's incremental costs associated with those costs are being capitalized on the balance sheet, we're not seeing a real reflection of free cash flow. And I think they are, because there's no way that you build another facility and your costs don't go up.
Well, sure, in that facility, obviously that's true. But if you cut costs elsewhere, then you have room to increase costs in China, reduce costs in the US and Europe, and then those offset. Don't you think that's a feasible,
right? But that would mean their costs in the US went to zero, right? If their costs aren't going up, they're going down.
Again, they've grown, operating expenses 80% over the last few years. I think SG&A is a bigger portion of that. I think probably up about 100%. So I've actually got the graph here if we want to flip over to that. But I think I think it's a valid point to be looking at the financials closely in that manner, but I also don't know that it's entirely fair to just assume, because essentially that would be accusing Tesla of being fraudulent with their accounting, correct?
No, I'm not making that accusation at all. I'm saying, how is it possible, right? I'd like to know where those expenses are. We're not making any accusations. I'm just trying to figure out how your operating costs stay the same when you have a new facility. Because if you say, well, they're making to broadly say they're making increases elsewhere, you can't say that, right? Because you have two facilities, right? Even if the Chinese facility is 50% more efficient, your costs would be up roughly, 40 to 50%, and we haven't seen that. So we're not making any accusations. What we're saying is, where are those costs at? And because we're not allowed to ask questions on the conference calls, and nobody asks these questions, they just don't get answered.
Well, I think, all of the entire operating expenses of the company, because Tesla is so vertically integrated, are not associated with simply one factory. It's not all in Fremont. They have their service centers, they have their stores, operations. Those costs are broadly spread. So there are a lot of areas for Tesla to reduce costs other than simply trying to take it all out of Fremont to support China, for example.
Yeah. What are the areas? How do they
Stores
reduce costs so aggressively? What's that?
Stores and service. And then in the supply chain, Tesla's vertically integrated.
Their service margins are deeply negative. There's been a number of lawsuits where people have said they take their cars in and the warranty, they're not classifying as warranty, they're classifying it as quote unquote goodwill. And thus their warranty expenses are significantly understated, which would also boost artificially, margins, et cetera. So, we could get into all of that. I don't think that does justice. I think the broader story is Tesla should be growing its sales significantly. It's not, right? Its sales peaked essentially in the fourth quarter of 18.
So let's talk about that.
Tesla's margins should be growing significantly. They're not. They peaked in the third quarter of 18, right? EVs, right? Electric vehicles, they're disruptive, right? That's what everybody says. So EVs should be growing significantly as a percent of auto sales. They're not. 2011, they were 0.03% of global auto sales. 2019, they're 1.7%. That is minuscule. And that's despite the fact that pretty much every country in the world is throwing billions of dollars in incentives at auto purchasers, saying buy an EV, will essentially pay for 20, 30% of the car. And despite that, the market share is negligent. So to say that EVs are disruptive, the data the numbers just that's completely wrong.
Well, even using those numbers, if you go from 0.3% to 1.7%, that's still 6x over less than a decade. I would still say that's pretty significant growth.
That's crazy. That's crazy. So in the
it takes
US,
time. It takes a lot of time to build these businesses.
Well, no. So in the U.S., those same numbers. All right. So let me say this then. In the U.S., their numbers have went from 0.3% to 1.9%, right? 2011 to 2019. However, pickup trucks have went from 50% to 70%. So to say it's 7 times. Again, you're not getting billions of dollars in incentives to buy pickup trucks, but that's what people are buying. So to say that the technology is disruptive at 1.7% market share globally and in the U.S., that's just wrong. It's just not right. If the technology was disruptive, they would be taking over. One other thing I'll note is, people say Tesla is a technology leader. Again, they don't make their own batteries. They buy from other people, right? Think about this, right? How can Panasonic sell exclusively to Tesla when EVs are only 1.7% of global sales, right? That's every EV. They can't. They have to sell to everybody to stay in business. But what I'll say is, it's just you're not seeing the disruptive technology that everybody's saying EVs are. And if you want to look at real disruptive technology, look at pickup trucks, right? That's the preference. That's what people are buying. 20% market share gain over that time frame, whereas EVs have gained like 1.5% market share. So
do you
I just
believe
think
that pickups have changed that much, or do you think that's just a shift in consumer purchasing habits? I don't think a pickup from 2019 is disrupting a pickup from 2011.
But it doesn't really matter what I think. That's what's beautiful about numbers. The numbers are what they are. The numbers show that pickup trucks have went from 50 to 70% market share. EVs have went from 0.3 to 1.7, despite the fact that EVs have been given billions of dollars in incentives from pretty much every single government. You buy an EV in the U.S. today, not a Tesla, you're getting a $7.5 thousand tax credit. You buy a pickup truck, you're getting nothing, right? So I would argue.
Well, that's not entirely true, because for a pickup, that's not entirely true for a pickup, because if a vehicle has a gross curb weight over 6,000 pounds, you do actually get a significant tax benefit if you're part of a business, which a lot of pickup truck purchases are. So it's not necessarily fair to say that there's no federal incentives for purchases on pickups either.
I mean, these are like cherry picked points. If you and I go out to buy a car today and we buy a non-Tesla EV in the U.S., we're getting a $7.5 thousand incentive. If we buy a pickup truck, we're getting nothing, right? So I haven't
Sure,
looked
but
at
if
the
you're a
data
business,
with respect
that's not
to,
accurate. You're actually going to pay
yeah, but
more
to
for
say
a Tesla
that
than
to say
for a
that
pickup.
businesses are buying the bulk of pickup trucks, like I haven't checked that statistic, but I would argue that statistic is incorrect. I think it's
Well, I would say
individuals.
businesses are buying more pickup trucks than people are buying Teslas.
Right, but what is it like? What is it? Businesses like 5% of pickup purchases, whereas individuals are 95%. So to just blindly
stats,
say
but
that
we should
data point, I
definitely
believe, is cherry picking.
All right, so
you get my point, though.
I get your point.
Let's take a step back. The point is the technology, the quote unquote technology. I don't think EVs are technology. It's just a car. It has not been disruptive by definition. It has not been disruptive yet. Everybody keeps using this word disruptive. Look at the numbers. The numbers show 1.5% market share gains. The numbers show Tesla's sales peaked in the fourth quarter of 18. The numbers show
so that's the point I think we got to talk about more. So I think we have to talk about the growth stories, because obviously I think, everyone in the entire world should agree that Tesla is not priced on the fundamentals today. That would be crazy. They're priced on the potential for future growth and the discounted cash flow that growth may allow for. So entirely agree that Tesla needs to grow from here to make any sort of sense for their valuation. But you keep saying that the sales have peaked in Q4 of 2018. I think revenue then was like 7.1 billion. Since then, I think they've had a quarter at about 7.4 billion. But then that does not fit with your own forecast, because you have you're forecasting for Q3. I've got the note here that we can probably pull up, but I think you're forecasting 8.5 billion, right?
I believe that's about right. I believe that's correct.
All right, let me just go through it so we've got the numbers in front of us. We can talk through it together. So if it is in that ballpark, how does that tie with saying that the growth story is peaked? If 8.5 billion on a previous high of 7.4 billion would have been, that's 15% growth from their best quarter historically. So how does that fit with no
go
growth?
Up one more. Stop there.
Yep,
So
right
look at that exhibit, right?
Yep.
So in that exhibit, you can see that essentially almost 700 million of the revenue that we're projecting is from FSD and credit sales, right? Mm-hmm. So FCA has an agreement to buy credits from Tesla. They said from 2020 to 2022, they're going to buy about $1 to $2 billion worth of credits.
1.8 billion euros.
Tesla. I'm sorry?
1.8 billion euros.
I'm sorry, euros. Okay. So it's not all Tesla, right? So that works out to just over 2 billion, right? And it's not all Tesla. Over 3 years, right? So if you look at the amount that Tesla recognized in the first 2 quarters of this year in credit sales, it was about 700 and just over 700 million, or roughly 3/4 of what FCA is going to buy from them over the next 3 years. They recognized in 2 quarters. So they still have 406 million worth of credits to recognize this year based on their guidance. Their guidance is credit sales are going to double this year versus last year, double last year, take away the 700, and you get roughly 406 million. They also said they have 876 million in FSD revenue they can recognize over the next 12 months, right? So if we assume they recognize all of that, forget about 12 months, they recognize all that FSD revenue in the second half of this year, and we assume they recognize 406 million in credit sales in the second half of this year, that still gets us to a EPS number below what 50% below what the street is forecasting in 4Q. But that's not your question. Your question was on actual sales. Our point is this: next year, a lot of essentially Tesla's credit sales, we believe, are going to dwindle down significantly, potentially close to zero, because every auto manufacturer is now making their own EVs. So those are not just it's 100% gross margin credit sales, right? And the FSD revenue is 100% gross margin. So the point is, if you take away that revenue, right, that 100% gross margin revenue, this company starts losing money again significantly. So while we do expect strong sales, including the one-time credit sales, they define it as one-time, and the FSD, right, the attach rates for FSD have collapsed. You get a nice revenue number. But next year, we believe they're going to start losing money because the attach rates for FSD have collapsed, and they're not going to have as many credit sales. So if you look at their core automotive business, they're losing a significant amount of money in their automotive business every quarter. $300 million loss last quarter, excluding credit sales, again, are one-time in nature. So, and consider, right? Tesla has cut prices on its cars 8 times this year, 8 times, 3 of which were in China, right? So that suggests that, they should have strong sales.
Well, if you count all the individual if you're counting every individual market.
Important, right? But hear me out. If Tesla sold its cars for a penny, right, they would sell as many cars as they could produce. So revenue is not what's important when you're cutting the price of your cars consistently. What's important is profit. And taking away the one-time credit revenue, right, that's going to dwindle down significantly next year, they are losing money every single quarter. So I don't think revenue is the right number to look at. It's profitability, right? You and I could open up a lemonade stand and sell however much lemonade we want. But unless we cover our costs, we're not going to be in business for long. I think that's the dynamic a lot of people are missing here. No other car company reports deliveries, right? Because deliveries aren't what's important. What's important is profit per unit. And again, taking those credit sales away, which again disappear next year, it's a loss on every single car they're making, a significant loss.
Well, I would say the other automakers do report sales units, but it's just a the variance in the business model is such that they report their wholesale units because they're selling their units to the dealerships versus Tesla has to report deliveries because they sell direct. So I think that's the variance there. But on the growth story, I mean, I guess I don't understand how it's fair to say that the growth story is over and then also be projecting the best quarter, even excluding the regulatory credits, which I think we can go into more detail on. Even if we exclude those, you are forecasting as the most significant bear on Wall Street, you're still forecasting for huge quarter-over-quarter revenue growth from their all-time highs. So how does that, I understand your point on profitability, that's important too, but you're just assuming because price cuts have happened that the margins are going to decline. If we look at Tesla, that's what they've done throughout their entire history. They've lowered the prices of their cars, and their gross margin has remained relatively stable.
Right, but hold on. To that point of gross margin remaining stable, you got to look at their services and other division, right? So for pretty much every other car company, your services and other is your highest gross margin division because effectively the costs are extremely low. So when somebody takes their car in to be serviced, you're making a killing there. Their gross margins in services and other are decisively negative, right? So again, we believe that they're taking a lot of costs associated with, service and other items associated with the selling of their vehicles and pulling those into service and other. So it makes their automotive gross margin look a lot better than it actually is. So if you can explain to me why everybody else's services and under gross margin is 50% and Tesla's it's not roughly 50%, and everybody else in Tesla's is grossly negative, then I'll agree that their gross margins have been robust. But as of right now, I do not agree with that. And there are court cases and lawsuits currently pending where the lawsuits allege that Tesla has taken warranty and reclassified it as goodwill, thus taking it out of essentially their cost of goods sold. That inflates their gross margin, and yet nobody talks about this, even though there's literally lawsuits that have been filed. So again, I don't think their gross margin is as it appears, and I'd like the company to explain how their services and other gross margin is always significantly in the red. And
yeah,
again,
I think Tesla has talked about that. Let's stick on that point. I think Tesla has talked about that. One of the challenges with being an upstart automaker is that when you start selling vehicles, but they're not an upstart
automaker. That's another mistruth, right? This company's been around.
Regardless of that, let's stick on the point. So I think as a newer automaker, I think you could agree with that. Tesla's been in business 17 years. A company like Ford has been in business over 100 years. So Tesla is relatively newer. And it's certainly, if you look at the scale, Tesla's grown deliveries 50% per year every year. So they're roughly doubling their fleet every year and a half or 2 years. So they are growing more significantly than a normal automaker. That presents unique challenges for them and their business model. So one of those challenges is that the majority of their vehicles at any point in time, because of that rapid growth, are under warranty because they're within the first 4 years of ownership. That is not the case for a company that's been in business for 100 years that hasn't grown, significantly for the last couple of decades. Most of their fleet is already out of warranty, so that's why they're able to collect significant margins from service. I would also point out that internal combustion engine vehicles in general require more service.
Hold on, what does that have to do? Hold on, if they're out of warranty, what does that have to do with significant margins from service? How are those two related?
If a vehicle is in warranty, Tesla needs to cover the costs of that service. They're not generating revenue and profit off of that. Versus other automakers servicing out of warranty vehicles are then able to collect those margins, those significant margins on that business.
Right, or maybe the opposite explanation is Tesla's cars have significantly more issues, but we don't even have to go there. This is
an accounting
point. But okay. So what? But one thing you asked me, you said, how can I be guiding to or projecting, significant revenues and saying it's a busted growth story? I'm just looking at the numbers historically, right? Historically, their revenues peaked in essentially the fourth quarter of 2018. Their margins peaked in the third quarter of 2018. No one can refute that. That's a fact, right?
Well, it's not entirely factual. They did have a quarter higher than that since then.
Right. I said essentially it was modestly higher, maybe like 200 million. But I think that was the fourth quarter of 2019. But in both the first and second quarter, their revenues are below the fourth quarter of 2018.
So
and their U.S. revenues did peak in the fourth quarter of 2018. There has been no quarter where the U.S. revenues have been higher. Keep in mind, this is despite the fact that they have another facility in Shanghai and another model in the Model Y, and yet they're not selling on a revenue basis. They're doing less than what they did before they had another facility, another model. I think that's a big deal. That is effectively a busted growth story, right?
Well, what about the pandemic? Tesla's had their factory shut down for 3 or 4 weeks in China. They had their factory shut down for 7 or 8 weeks in Fremont. Tesla's inventory is very low. It's 17 days of supply versus other automakers are generally around 85 days of supply. So you've got 2 weeks of vehicles on hand. If you're shut down for production for 8 weeks, that doesn't work. You can't continue to grow your revenue without producing vehicles. So how does that should be a major consideration when we're talking about Q1 and Q2.
Right. There's an easy way to look at that. Every automaker was affected by the pandemic equally.
Differently.
Right? So you look to market share. So what I do is I look to market share. So what has Tesla's market share done fourth quarter of last year to today, right? Fourth quarter of last year in Europe, their market share was about 35%. Today, it's about 9%. So everybody was affected equally. Tesla is hemorrhaging market share. In the US, right, their sales are declining. In China, they're not hitting their numbers. So everybody was affected equally. So to say it's pandemic, that doesn't pass the sniff test because they're losing significant share in all of their key markets. And keep in mind, right, we haven't even seen the effects of the Mach-E in the United States. We haven't seen the effects of the ID3 or the ID4 from VW. We haven't really seen the effects of the Taycan. We haven't seen the effects of the 12 EVs that GM's launching between now and the beginning of 2021. The competition hasn't even started to arrive yet their market share is imploding. So you can argue
that's not accurate. Their market share is not imploding. If you isolate on Europe, sure, but Tesla's not going to ship a vehicle to Europe if they can sell it in the United States. It doesn't make sense. So it's not fair to look at Europe, specifically in Q1 and Q2, when there were shutdowns in the United States factory, which they used to produce vehicles for Europe, and then assume that Tesla's demand is cratering in Europe because they couldn't ship vehicles over there. To say that
if their production, if they're supply constrained, right? If you look at what they say their production capacity is, they should be selling about 175,000 cars per quarter. That's excluding the inventory. That assumes their inventory stays flat. So really, it should be 200,000. So even if they do hit our number of 140, that suggests that they're not supply constrained, and there's not enough demand to meet their current capacity, despite the fact they have plans to build 2 more factories. So we can talk about capacity.
We can talk about capacity here in a second because I think that's a valid consideration that we should discuss. But I do want to stay on the market share point because I don't think it's accurate to say that Tesla has lost share, and I also don't think it's accurate to say that every automaker.
What do you mean it's not accurate? We have data. Their market share in Europe has went from 33% to single digit.
Why would we not talk globally? What do you mean
that's Europe? Europe is the most important EV market in the world right now.
Why would we not talk globally?
How can you just say that's Europe? How can you just say that's Europe? Forget about Europe.
All right, so let's look at
their U.S. revenues peaked in the fourth quarter of 2018. So
let's look at some numbers
here.
Well,
they can sell in the U.S. They haven't sold more in the U.S. than they sold in the fourth quarter of 2018, despite the fact they have a new model. So clearly things aren't going well in the U.S. either.
So let's look at some numbers. Here are Q2 results from every automaker. Tesla's sales were down 5%. Everybody else was down 40% on average. Obviously, a lot of variance between automakers, but I think BMW and GM performing the best around down 24 versus Tesla down 5%. So how can you say that Tesla is losing market share globally?
Because they are. How can you show revenue growth and then attribute that to market share? Well, sales units, but
that is market share.
GM. You're looking at GM's sell of everything they sell. They sell EVs. They sell pickup trucks. They sell regular cars.
Yeah.
Again, I don't know how you can argue that this point is not. You can't argue this point, right? I'm looking at Europe. Their market share has went from 35%.
Why would we focus only on Europe? That's my question.
Right. So where
Why
are
would
you
we not?
saying they're gaining
Globally.
market share, and where is that data?
Globally, and that's what I was just showing. So if we go back to that, this is sales units in the second quarter. Tesla was down 5%. Everyone else was down 40%. Tesla gained share.
Yeah. What
That's
are
just
these
how the
units?
math
What
works.
I can't even see what you're showing me here. What are these units you're showing? Like, what are these units?
It's just deliveries, sales units, however each automaker defines it. This is the results. And if
Right.
we want to look
But how
strictly
can
on
you compare
revenue, the results are similar.
an EV company? How can you compare a company that only sells EVs to a company that sells, pickup trucks, regular cars, light vehicles, trucks, etc.? That's not comparing apples to apples. You're comparing apples to oranges.
Well, you're paying
So
cars
you
to
can't,
cars.
I don't think that's a fair comparison. It's
right,
not a fair comparison. You can't take a company that sells 11 million cars a year, vehicles, and then compare it to a company that sells 375,000 EVs a year and say in the first quarter this guy's revenues were down this much versus this guy's units being down, or units were down this much versus, and then say they're gaining market. That's incorrect. You have to have EV data
in the total
from every
automotive
single company, and that's the data you have to compare to.
I don't agree with that. 95% of people that buy Teslas are trading in internal combustion engine vehicles. It's not just an electric vehicle market.
Okay, I mean, so I disagree with the analysis you just put forth. I think you have to compare EV. When you look at Tesla's market share, you have to look at it from an EV perspective. That's what we do in Europe. That's what you have to do in the U.S. and China. We can say theoretically, people buying EVs, buy, ICEs, et cetera.
It's not a theory. That's
when
the
you look
number.
at market share, you look at it as a percent of EVs.
I don't agree with that analysis. I think we can probably move on from that point. But to me, the data shows, as you said, we should look at the data. If 95% of people are trading in internal combustion engine vehicles for Teslas, only 5% are changing in electric vehicles, then that's, how is that comparing apples to oranges?
Yeah, but see, when you throw
it's
these
literally the
numbers out,
product that people. It's literally the product that people are trading in for the other product.
But hold on, I feel like these numbers are extremely
This is the highest level number.
But hold on, hear me out. You're saying 95%, right? When we know that EVs are just 1.7% of global auto sales. So 95% of what? 2% of people? Like, that's an extremely misleading number. The other 5% is most likely people trading in Teslas to upgrade on their Tesla. Right, but if you're just looking at people who buy Tesla cars and looking at what they do, okay, I don't know those numbers. I don't know how you get those numbers. But when you throw out a number like 90, you said 95% of people trading in cars are buying Teslas. Like, what is that? Like, I don't even know what that statistic is, because
when a Tesla purchase is made,
less than 2% of automobiles are EVs, not just Teslas, EVs. So 95%, I don't think you can apply to any analysis when looking at EVs as a percent of auto sales.
The main point is that people are trading in internal combustion engine vehicles for Tesla vehicles. So to say that
where is that data point from? How did you
Bloomberg, from Tesla directly? It's all over the place. There's tons of analysis out there. You can look at the Bloomberg study. It shows that.
Yeah, but see, you can't just throw out this tons of analysis. I need the specific number. Are you simply saying, because if EVs total are only 1.7% of auto sales, there's no 95% to apply here. So I assume
think you're misunderstanding what I'm saying.
What you're probably talking about is you're looking at some Tesla forum, right? And you're looking at Tesla owners, and you're asking those Tesla owners, did you trade in an ICE to get your Tesla? And 95% of those people said yes. If that's what you're looking at, okay, I understand that. But that's a very cherry-picked data, right? You're just looking at people who are buying Tesla cars. Did you trade in an ICE? Of course they did. I mean, what else would they own?
That's the point. That's the point.
EVs on the road.
That's the point, though. It's the same market. If people are trading in one product for another product, it's the same market. You can't say it's apples and oranges when people are literally trading the apple for the orange. It's just, how does it make sense to not look at the entire global auto market if people are trading in one for the other? It's not just EV versus EV.
People who are, you're doing a survey on people who are buying Tesla cars. Right?
I'm not doing the survey.
Before Tesla, probably all of those people owned an ICE vehicle. So to say that, to quote that statistic and then apply it to the global auto market is extremely misleading, because we know that BEVs total are only 1.7% of global auto sales. So there is no 95% number that you can apply to the global auto market as it relates to EVs. If you want to look
stuck on the number, the main point,
okay,
the only point I'm trying to,
whatever metric you want, but that's not helpful to the broader dynamic and discussion. I think it's misleading.
The percentage is not important. My point that I'm making is that people are trading internal combustion engine vehicles for electric vehicles. So it makes sense to look at the market.
What do you think happens to Tesla's earnings next year when credit sales go to zero?
Credit sales are not going to go to zero next year. The contract, the agreement with Fiat Chrysler is for 1.8 billion euros. We don't know for sure that that's all Tesla, but that's what it sounds like. And if we want to stick on this regulatory,
it's for 1.8 billion euros over 3 years, right?
2020 to 2022.
We know that it's not all Tesla. They said it's not all Tesla. They say it in their financial document. So if you assume it's 80% Tesla, you can argue with that all you want. That's the assumption we made. And you take the amount of credit sales that Tesla did in the first 2 quarters of this year, that's 3/4 of 3 years worth of credit sales. So you're right, they won't go to zero, but they're going to decline significally. And if they do another,
all of Tesla's recognition of credits are not Fiat Chrysler as well.
If they do another 406 million in the back half of this year, there will be literally no FCA left. So will it be zero? Maybe it's not zero, but it's not going to be hundreds of millions. It'll probably be like closer to 50 million a quarter. If you take that 428 million to 50 million that they recognize in credit sales in 2Q, they lose money every quarter. So again,
well, they lost money in 2 quarters during a pandemic. I don't think that's fair to say that the exact same situation is going to apply next year. And on the regulatory credits, I did want to talk about this. The first point I would say is that not the entirety of the 700 plus million that they've recognized in the first half of the year comes from Fiat Chrysler. Tesla has had regulatory credit revenue consistently before that deal was in place. It's boosted the regulatory credit revenue, obviously, but it's not fair to just assume that that's all coming from Fiat Chrysler. The second point is that $140 million of that revenue that was recognized in the first half was deferred revenue from 2019. So it's not fair to include that in the calculations that you're making going forward and say that that's a percent of Fiat Chrysler's commitment to Tesla, because that was already earned previously. It was just recognized this quarter. And then if you exclude that, then Tesla's actually more around like 640 million. And as you said, they guided for roughly double last year, which was 594 million. So they're actually guiding for a pretty linear revenue recognition.
What's 640 million? What number is that? I'm sorry.
So it's 782 million, right? That's the credit number for the first half of the year.
Okay.
So if you take $140 million of that out, which was only recognized this year, but was actually earned last year, this is in their financials in the 10Q. Okay. If you take that out, you're at 642 million. Last year, Tesla was at 594 million. They guided for double this year. So if you double 642 million, you're pretty close to doubling of 594 million. So their guidance completely makes sense in that context, even if the recognition is completely linear, except for that 140 million that was earned last year.
The point is the credit sales in the back half are going to be down versus the credit sales in the front half of this year. So that's going to be negative to their earnings. And then in 2021, when those credit sales drop significantly, they're going to go back into burning significant amounts of cash. And that is not what the street is projecting, right? Pre-split, the street's projecting they're going to make roughly $20 in EPS. I think their EPS next year is going to be negative. So when that becomes a reality to people invested in this stock, I think the stock's going to get hammered. Listen, they're not in the business of selling regulatory credits. In their financials, they state those at one time. They're in the business of selling cars. And in that business, they lose money, a significant amount of money. So can they raise money right now? Yes, they can. But if you have a structurally loss-making business that's about to face unprecedented competition, that's not a good outlook. And I think that a lot of these, cherry-picked data points that you highlighted, I think, are painting the wrong picture for people investing in this stock, right? They don't know what they own. They don't know that they own a company that burns money. They don't know that EVs are only 1.7% of global auto sales. They don't know that Tesla's revenues peaked 2 years ago in the U.S.
Didn't.
They don't know any of these things. So I think you got to make sure you paint the right picture. And look, this isn't hate on Tesla. What Elon Musk did for EVs is great if you're an EV enthusiast. But the problem is, I think Tesla is more analogous to AOL, not Amazon, because or BlackBerry, right? They're the first to come out with the EV, and now all the big boys who actually make money selling ICE cars, right? GM can literally give its EVs away because they make money selling ICE cars. Same thing for VW, etc. These guys have a profit engine. Now they're coming in and they're coming after Tesla, right? So you see what happened in Europe, right? Before there was competition, Tesla dominated. Competition came in, their market share went from 33% to single digits. So the question is, what's going to happen globally as all these cars start to span out globally? I think you're going to see a similar dynamic. And I think to focus on the numbers, not this, trying to cherry pick positive data points.
I'm only talking about regulatory credits because you brought up regulatory credits.
Their revenues peaked. What's that? I'm sorry?
I'm only talking about the regulatory credits because you brought up the regulatory credits. So I'm just trying to clarify the situation of the credits. That was
the credits are one time in nature based on Tesla's own disclosure. The reason why auto companies buy credits from Tesla is because they didn't make EVs. Every auto company is making an EV. So that 100% revenue stream is going to dry up for them going forward.
That's
They're trying to tell you it's one time. And it is.
Yeah, and that's fine. I'm not going to argue that regulatory credits are going to exist forever. That's, no one's buying Tesla stock
So
because
without
of that.
regulatory credits, over the past 32 quarters, and only 4 quarters has Tesla been profitable, the most recent of which was the third quarter of 2019. So if they don't make money without selling credits, how can you be so optimistic on a company that's business just perpetually burns cash when you don't even have competition yet, right? Competition is coming. I just don't see how this, how this matches up.
Well, competition has been coming for a decade now. I mean, the Chevy Bolt
but it just arrived,
beat the Model 3 to market, and that was sort of the death knell of Tesla at the time.
Well, no. So what happened? No, you got that wrong. So what happened is in Europe, right? If you sold an EV car in Europe last year, you didn't get any credits towards your mandated EV sales. Only in 2020, if you sold EVs in Europe, did you get to take credits against basically the mandates. So what happened is everybody slowed down. They didn't sell a lot of EVs. And now everybody in Europe, because it's government mandated, they're selling EVs. When that happened, right, Tesla's market share literally imploded. This isn't debatable. This is fact, right? So now you have GM coming in the US with 12 cars. Ford is coming. Porsche is coming. VW is coming. So what's going to happen here when you have choices, right? Tesla's not the only option. I mean, we saw what happened.
What about
in
the United States market? You seem very heavily focused on Europe. Tesla has gained share in the United States. Their market share of electric vehicles, if we want to not talk about internal combustion engine vehicles, which I don't think is valid, but if we just want to talk about EVs, Tesla's market share has held steady at 80%, even though, as you noted earlier,
well, we don't have that data. They stopped reporting that data to Inside EVs, so we really don't know what their market share is.
Well, they never reported it to Inside EVs.
I would argue that
these are all estimates.
There haven't been any real EVs in the U.S. That's happening now, right? In 2021, you're going to have 12 new EVs from General Motors. Ford is launching the Mach-E, which is oversubscribed, and dealers are selling it for $15,000 above MSRP because there's such high demand. VW is about to ship the first ID3 and ID4. The Volvo Polestar just hit, right? Car and Driver says before you buy a Model 3, or a Model Y, you got to drive this car. It's better, right? So my point is, you haven't had competition in the U.S. It's coming, right? We're going to see it.
What about the Chevy Bolt? What about the Jaguar I-Pace? What about the Porsche Taycan? Tesla has had competition in the United States, and they've been at a $7,500 disadvantage against that competition, and yet they continue to outsell it.
Those are highly expensive luxury cars, right? And
the Chevy Bolt
hasn't shipped a lot of Taycans. Porsche hasn't shipped a lot of Taycans to the U.S. Look, when you say, the real competition for Tesla is the Polestar. It's the ID3, the ID4. It's the Mercedes EQC. It's the BMW EV that's coming. It's the Mach-E. You can't buy those yet in the United States, but you will, right, in the fourth quarter of next year. So we'll see what happens. We saw what happened in Europe. It's not that I'm just focused on Europe. It's just Europe is the only market where we've had real competition and there's real market share data, right? Where's the U.S. market share data? Tesla stopped reporting those monthly numbers to Inside EVs. So we don't really know what the market share is.
Well, you say we know China and we know Europe. So if we know those two, we can factor out and get the United States. It's not that difficult. We have to estimate, of course, but we still have round numbers.
No disrespect, but that's ridiculous, right? You'd have to know the sales of those cars, not just Tesla cars, but every single car in each market, and then you have to do back into those numbers. That is not easy to do. It's not something you can do. You can't say, Tesla sells this, and you can do that for Tesla, but to get market share, you need it for every car that sells in the market. We don't have that data for the U.S. So to say
that, if you can estimate it for Tesla, you can estimate it for anybody else.
To say they've maintained their hold on, I'm sorry, what was that?
If you can estimate Tesla from extracting total global sales from subtract Europe, subtract China, get the U.S., you can do the same process for any other automaker.
I'm saying you can estimate Tesla's U.S. sales. You can't estimate everybody else's U.S. EV sales without that data, right? And we don't have that. But
it's the same data. I mean, it's the same data. The same process you would use to estimate Tesla's sales is the same you would use to estimate any other automaker. It's the same reporting.
Right. So look, we don't have to talk in circles here. Where is the data that shows their market share has been the same this year? Right. Where is that data? Or is that just a statistic you're throwing out there? What's that?
I can send you links afterward. I don't have it handy, but it's from carsalesbase.com. There are other sites that track this stuff. But I mean, all you need to look at is the total sales for the quarter. And, it sounds like you don't want to look at that data because it includes internal combustion engine vehicles. So we can't necessarily, I don't have the data for just electric vehicles right in front of me, but Tesla's sales were much better than other automakers for the quarter, even though they had less inventory heading into it.
I don't want to, we don't have to belabor this. I don't know what Tesla's market share is in the US. I don't think that's important right now because, again, there's not a lot of EVs being sold in the US that compete with Tesla. To compare a $40,000 Model 3 to a $120,000 Porsche Taycan, I think those are two different geographies.
They're completely different. But I also mentioned the Chevy Bolt, which starts at $37,000.
Let me say this. So for you to say that the I-Pace and the Jaguar have, the I-Pace and the Taycan have been here, those aren't comparable, right? The comparable cars will be the Polestar. It will be the ID3 and the ID4. It will be the EQC. It'll be the Mach-E. Those will be the comparable cars. And those cars haven't launched yet. So Tesla hasn't had competition in the U.S. Despite that fact, their U.S. revenues peaked in the fourth quarter of 18. So what do you think happens when competition? Peaked. Their U.S. revenue. Their U.S. revenue. Their revenue in the United States peaked in the fourth quarter of 18. Global revenues essentially peaked in the fourth quarter of 18.
You're forecasting for $9.7 billion in revenue in Q4. I don't understand how you can forecast for 32% more revenue from Tesla versus their best quarter ever and then say that growth has peaked.
Well, I mean, it's quite easy, right? They have a whole nother facility that's producing 220 to 230,000 cars, peaked. And they have a new model. So they should be seeing growth. I mean, their growth theoretically should almost be double, right? And the bulk of our revenue, not the bulk, a big percentage of our revenue are one-time credit sales in the fourth quarter.
Well, less than 10%.
And one-time FSD attach rates have declined significantly given the past two price hikes they've done. So to say that you don't understand, listen, they have another facility, right? So they're going to sell more cars. So that's why we're projecting more growth. But for this
then you can't say that the growth story is over if Tesla's going to sell more cars. Those are incompatible statements. It doesn't matter if they have an extra facility.
Based on the numbers they've reported thus far, the growth story is over, right? The revenues peaked.
Sure, thus far.
Like, this is a
but
fact.
you yourself,
you can look to my projections.
You yourself are forecasting for growth.
My projections are just that. They're my projections. Hold on, but my projections are just that. They're my projections. And I'm assuming price cuts, right? I'm assuming Tesla's going to have to cut the prices of its cars to get to my numbers. I said that in the note. If you look at what they've reported thus far, it's a fact that it's a busted growth story. Their growth peaked quarters ago. You can't argue that. That's a fact, right? Their revenues in the first and second quarter of this year were less than they were in the fourth quarter of 2018. Their revenues in the U.S. peaked in the fourth quarter. This is just factual. So,
it's factual historically, but it's not factual going forward, even by your own forecast.
Well, no, the growth we have in our forecast, again, is based on them having a whole nother facility and a new car, right? With a whole nother plant, right? They had one plant, now they have two, right? Theoretically, they should be selling double the cars. They had 3 models, now they have 4 models, right? The Model Y. They should be selling a lot more cars if you're saying that there's unlimited demand. And they're not. If you look at our auto revenues, they're not growing significantly.
But you're guiding for them to sell a lot more cars. You're guiding for 177,000 sales in Q4 versus an all-time high of 112,000. They are selling a lot more cars, even by your own forecast. It doesn't matter if they have an extra facility.
Right.
They're still selling those cars.
Right, but those car sales are being achieved via cost cuts and deep losses in their core business.
That's the whole goal of Tesla.
Again, you can't just look at a company's revenues when they're losing money at doing what they do. Again, if you and I had a lemonade stand and we gave the lemonade away for free, we could sell unlimited, infinite amounts of lemonade, but we would be out of business. Without capital raises, if you're in a business that perpetually loses money, which Tesla is, you're not going to make it.
Tesla has not perpetually lost money. Up until the last couple of years, Tesla has lost.
Over the past 32 quarters, in only 4 of those quarters, excluding credit sales, have they been profitable. That's a fact.
Would you agree that it's more expensive from a profitability perspective when you're growing a business rapidly versus when you're not?
They've been around 17 years, so you can't keep treating them as if they just IPO'd yesterday.
Well, they've been still growing like they IPO'd yesterday.
They've been around longer than Facebook, right?
The point is that it costs. The point is that it's costly from a profitability perspective to grow.
Are they just going to perpetually be able to lose money, and the excuse is going to be, oh, they're growing? I mean, come on, you got to make money in your business.
Do you agree that it is more expensive for a business to grow?
People take this stuff personally. This isn't personal. This is just factual, right? There's no need to take this personally.
That's why I'm trying to stick. That's why I'm trying to stick on the fact.
Tesla's automotive business last quarter, excluding one-time credit sales, lost $300 million. That is not sustainable forever, because essentially when they can't go to market and raise money, right, they will go out of business because they lose money. So they have to start being profitable in their core business of selling autos. And again, a big risk to this story, and you need to really focus on this, is everybody is now making EVs. Everybody. So nobody needs to buy EV credits from Tesla. That revenue stream goes away. 100%, no costs associated with that. They go back into deep losses. When that happens, I think a lot of professional investors are going to say, hold on, these guys are supposed to be going into profit. You know, they were supposed to be cash flow positive every quarter. What's going on? I think it's going to be a big problem. That starts next year.
I mean, Tesla's free cash flow over the last 12 months has been a positive $1 billion, even with a global pandemic. So I'm not sure how you can sit there and say that they're losing money. So even if you extract out the $782 million of regulatory credits, they've still been free cash flow positive while growing globally, building out 3 new factories. So how can you say that they're losing cash?
Again, there's a lot of questions around what's reported versus what's capitalized. Do you understand that? Do you understand what it means to capitalize an expense?
Yes, of course. But the point is that
what does it mean? Because I don't know if you do. I just want to know. What does it mean?
It goes into CapEx, so it does not hit profitability until it comes back through depreciation and amortization.
That's incorrect. When you capitalize an expense, you put it on your balance sheet, so it's not reported in your financials. So if it's not reported in your financials, it doesn't go against your cash flow. So if you're capitalizing expenses that are actually contributing to your business, then you're actually inflating your reported free cash flow. So when you keep reverting to this free cash flow, what I'll say is, again, I want to know how your expenses can be flat when you had 1 plant and now you have 2, yet your expenses are flat. How is that possible? I'd like an answer to that, because if we don't have the answer to that, I'm not as confident in the cash flow numbers they're reporting. Why does Tesla perpetually raise money? Why are they perpetually raising billions of dollars? Last year, they did $1 billion capital raise, and Elon Musk said there were going to be 1 million robo-taxis on the road this year, and the cars were going to be appreciating. That did not happen. So, you know, that was incorrect, right? You would argue that the FTC would step in, the SEC would step in and look at these type of things. I'm not saying there's anything nefarious. I don't know. But he said something that, based on what's happened, was factually incorrect. And he used that to raise $1 billion. If they're so free cash flow positive, why did they keep raising money, right? They had $8.2 billion as of last quarter. Why are they doing an at-the-market equity issuance for $5 billion? Why? If they have the money, they're generating cash flow, why are they perpetually raising cash? Why aren't you asking yourselves these questions and asking the company? I would, but they won't talk to me.
So I think on the at the market, if Tesla is so cash restricted and they need all this cash because they're capitalizing their assets and not reporting it properly from your perspective, why would they not just do a normal offering? Why would they do an at the market offering that only allows them to raise if the stock price goes up?
Because there's not demand. There's not institutional demand for $5 billion worth of Tesla stock.
At a $400 billion valuation, you don't think they can sell 1% of their stock?
Right, their largest shareholder, Valley Gifford, just sold 40% of their position.
Because it's 10x.
You asked me a question. Let me answer. Let me answer the question. You asked me, why are they doing an ATM, right? The reason is because there's not demand for their stock in the market. There's not institutional demand for Tesla stock at these prices. So they have to do an ATM, because I would argue need of cash. That's the only explanation I could think of, right? Because if you're about to get included in the S&P 500, theoretically, you could do a massive raise when you get included and dump that stock onto essentially, passive investors. So why are you doing an ATM? We're supposed to find out tomorrow if they get included, days ahead of you getting included in the S&P 500. The only explanation we believe, and again, this is our opinion, is that they're in desperate need of cash. I would like to know any other explanation for that.
I think there's a pretty simple explanation. At times, the S&P committee can go to companies and say, when they're on the cusp of inclusion, would this company be open to issuing some additional capital to help fulfill the demand for these shares that are going to be required with the S&P inclusion?
Yeah, respectfully, I'm sorry, that makes absolutely no sense. I don't know if you've ever spoken to anybody at the S&P, but that explanation, I'm sorry, that doesn't make any sense.
That has happened.
I completely disagree with that.
I know for
when
a
has
fact
that happened? With what company has that happened?
I know for a fact that it has happened based on conversations that I've had.
With who? Whatever.
I'm not saying with Tesla. I'm just saying with companies in general.
What company in the S&P 500 has ever done an ATM equity issuance? Name me one.
That's not what I'm saying. I'm saying that the S&P committee has gone to companies and asked if they would be interested in doing an equity raise.
Understand.
So you can't say that that's not a possible reason.
ATM issuance are typically reserved for companies that are struggling. They don't have access to capital markets, so they need to do ATM issuance to raise capital. We cover a company, Tilray and ACB, who are struggling, who are currently doing that. There's no, I don't know any.
So what do you make of the other analysts that have
$5
said
billion
what do you
company or above that does ATM issuances?
What do you make of the other analysts that have been out on this report that have said that Tesla, with the high market cap right now, has extreme access to capital?
I think the ATM issuance, suggests that is not true. And what I'll say about the other analysts, I see analyst commentary. One of the analysts said, Tesla. He said that ahead of the August numbers. The August numbers preliminarily are 11.5. That's a disaster. Where is his update to that comment? I think analysts in Tesla are doing extremely poor work. I don't think that people are looking at the actual numbers. And I think as a result, a lot of misinformation is being put into the market. Like, I think a lot of retail investors believe Tesla makes its own batteries. They don't. I think a lot of retail investors believe Tesla does
have proprietary technology in the batteries that they use. That's factual.
Anybody can buy the same Syndrilic batteries that Tesla buys from Panasonic, or the batteries they buy from LG or Cattle. Anybody can buy those exact same batteries. How Tesla puts them together, how they strap the batteries together, okay, but that's not technology, right? Anybody can buy the exact same technology that Tesla buys. They're not buying the batteries that Tesla uses. The batteries that CATL is making, that Tesla.
So why is Tesla's powertrain more efficient?
Available to any automaker.
Why is Tesla's performance and efficiency much better than their competitors if anyone can just go and buy these batteries, like you're saying?
Well, there's been a number of articles, one of which was written in the Washington Post, that suggests if you actually go out and test their cars, their range is far less than what they say. I'll send you those links. I don't have them at hand. So I don't know if that statement is true that you're saying. In fact, the tests that have been done would suggest it's not true. So we'll see. But there's guys like, Lucid and, GM has a car that are saying they're going to have significantly more mileage than Tesla. And again, when you go out and actually test the cars versus what they state, the mileage isn't what it seems. So, I think that your statement is not factually correct. And again, I'll send you those links.
So you think that Tesla has no technological advantage in their powertrain versus anybody else?
Absolutely not.
Okay. I think we're getting pretty close to an hour here. I think this has been a good back and forth. I think there's a lot of stuff that we probably should follow up with each other on. One of the final questions I guess I would have what would it take for you to sort of change your mind on Tesla? I'm sure you're never going to be a Tesla bull, but you said the growth story has ended. What's it going to take for Tesla next year to show you that thesis has been invalidated?
Look, it's not that I'll never be a Tesla bull. There is a scenario where I can be a Tesla bull. It's simple. They make money selling cars, right? That's their business. Not one-time credits, not vaporware, full self-drive, which doesn't. They're selling for $8,000, right? You lease a Tesla car, you buy the full self-drive vaporware for $8,000. This is our opinion. We believe it's vaporware. It doesn't exist. And then when you turn that car in, they take it out and sell it again to somebody else. We see problems with that. So my point is, I would become a Tesla bull if, excluding those one-time numbers, they showed profit in their then I'm a bull. If they don't do that, I don't think it's a sustainable business. And again, it's a busted growth story, and they don't have any technological advantage. And I think people saying that their batteries, they make their own batteries and they have some type of advantage, that's extremely misleading to somebody like my mother, who doesn't know anything about stock. What she'll take from that is they make batteries, they don't, right? To say that they have a technological disadvantage in full self-drive, Navigate ranks them dead last in autonomous driving. Dead last. Germany, a judge in Germany just ruled that they can't sell, basically assisted driving, and when they're selling their cars, because it's misleading to consumers.
Gordon, have you used Autopilot at any Autopilot for self-driving features?
Listen, I'm not. Look, I'm one person out of
I understand that.
In the world.
I understand that. I agree with that perspective.
I would never trust my life to Tesla's Autopilot technology. And this isn't a swipe at Tesla. I wouldn't trust my life to any car's Autopilot technology right now. It's not just Tesla.
So does that mean that you have not used it?
I've seen the videos where people have Tesla on Autopilot and it veers off and hits something, or when it's hit a stationary car. I've been in an auto accident. It's extremely traumatizing. This isn't a Tesla thing. I just wouldn't trust my life with Autopilot. I don't think we're anywhere near full self-drive. And I think to sell that technology is not only misleading, but it's causing and has caused deaths. So again, I'm not the guy to ask, have I used it? I would never use it. And if I was in somebody's car, I have been in Tesla cars, but if I was in somebody's car and they turned that on, I'd tell them to stop and let me out in the middle of the freeway. I value my life.
Yep, and that's a fair perspective. Obviously, any car accident is a horrible experience for anybody to be in, so I can totally understand that perspective. But I do think it would be helpful to understand the technology to be able to compare them, because regardless of Navigate rankings, Tesla right now is able to collect the most revenue, the most profit from their sale of software through the Autopilot suite. Whether you disagree with some of the terminology they use or not is a different matter. Whether you disagree
What's not
with
me disagreeing? A German judge ruled that they cannot sell that technology in Germany because it's misleading.
They can sell the technology, they just have to change a couple of the words, and they're appealing that. So we'll see how that comes out. But they literally call it Autopilot, which is the same assist system that is used in flights and airlines. So,
well, they can. My point is, they can appeal it all they want. That's fine. The court system. But a German judge ruled that was misleading because it's not what they say it is. That was an official ruling. So, look, I'm not. You asked me, would I use it? No. But there have been, I think, two or four confirmed cases where the death of the driver and/or the car that was hit was attributable to Autopilot. Using TeslaDeaths.com and using NHTSA's rulings that came out last year. So I just argue if one death is caused by technology that's not what it seems, that's too much.
What if that technology has saved 10 other lives that would have been lost otherwise?
I don't know how you substantiate that. I mean,
I'm just asking a hypothetical. I'm just asking a hypothetical question.
You can't just.
I'm not claiming that. That's just a hypothetical question. That's not a claim. It's just a question.
Okay, what was the question?
The question is, you said that it's never acceptable for the new technology to lose one life. But if that new technology saves 10 other lives, is that not acceptable? I'm just asking a hypothetical. I'm not saying that's the case.
Yeah, I don't want to answer that because I think that's an extremely misleading question. I don't think that. Listen, here's what I'll say. We are not anywhere near being capable of cars driving themselves around. I think you can see that. Just go to Google, type in Tesla Autopilot accidents, and look at all the videos, and then tell me that we're ready to have cars driving themselves around. We're not. That's my opinion, based on empirical evidence. So to say that it's saving lives, like I won't answer that question because I don't want to misconceive or deceive your viewers and have them go out and buy this technology and potentially put their life at risk.
Well, Teslas that have active safety features installed, which are as a part of the Autopilot suite, are in accidents much less frequently, about half as many accidents as Teslas that do not.
I can show you a data set that suggests that comment is extremely, completely wrong. I'll send that to you as well. So I owe you three things.
Okay.
What I ask is when I send you this data, again, this is not emotional. This is just data. Look at the data without any bias. That's all I ask. When I send you these articles, when I send you this Washington Post article, when I send you the Inside EV study that was done that shows that Tesla's mileage is far less than any other car. Some cars actually get more miles than what's stated. Look at the data. Look at the data and take it in. Again, I think Elon Musk has done wonders for the EV space. But as an equity, right, as a company that sells cars for profit, hopefully for profit, I think Tesla is very negatively positioned versus where it's valued at and versus the perception. And I think a lot of people are using misinformation and falsehoods to justify Tesla's valuation. They make their own batteries. They lead in FSD technology. They rank very last, right? They're a growth company.
I don't know that you can.
They haven't grown since. They haven't grown since the fourth quarter 18. It's disruptive technology. It's went from 0.3% market share to 1.7%. That is not disruptive. So all I ask is you look at the data and then look at some of these comments people make and really sit back and think about it. And also consider you have a lot of competition coming.
All right. Yeah. And Gordon, I mean, that's why I had you on the podcast. I'm all about, looking at data, checking facts, hearing the other side of the point of view. That's why I wanted to have you on this discussion. So I totally agree with that point of view. I guess my closing comments, since it seems like those are sort of your closing comments, would be that, Tesla has been free cash flow positive. You can argue that maybe they're capitalizing assets that they shouldn't be. I think that's up to everyone's analysis to determine. My point on their profitability would be it's very difficult for Tesla to show a profit when they're in such a hypergrowth stage. You're arguing that.
But again, I got to stop you there. You can't use hypergrowth for a
that's fine. That's fine.
Peaked 2 years ago.
That's fine. I don't believe
that's just not accurate, right?
It's not accurate to say. It's not accurate to say.
The revenues are not growing, so they're not in hypergrowth. They're in declining growth.
This
so when
is
I say busted growth story,
this is the most confusing part about our conversation to me is why you say that the growth is over when you're guiding for growth. Well, and I don't want to get on that train of topic because we've talked in circles around it.
But No, we don't have to talk in circles. I'm just looking at the past, right? This
Okay,
hyper
but
growth
you're
theory,
yourself look.
But no, no.
We
But hold on,
we
hold on.
as
Tesla
we
bulls
as
have been saying it's
investors need
hyper
to look
growth for
forward.
the past 3 years, right? Tesla's been hyper growth for years. Their revenues peaked 2 years ago. So like when you say you keep going to my numbers, like we don't know what the numbers are going to be. I don't know this is my best guess on what the numbers are going to be. But based on what the bulls have been saying for 3 years, that Tesla's hyper growth versus their numbers, it's not hyper growth. Their growth has been declining. So you're going to say, okay, they haven't been hyper growth, even though I've been saying they're hyper growth for 3 years. Their growth peaked 2 years ago, but I'm going to use Gordon Johnson's numbers for the next 2 quarters to justify hyper growth. I don't think that's fair. I think you got to look at what they've done historically. And historically, it's not.
To say that Tesla has not grown in the last 3 years is factually inaccurate. The Model 3 didn't exist in 2017. It wasn't out until the middle of 2017.
What do you mean it's factually inaccurate? Their U.S. sales, total revenues, peaked in the fourth quarter of 2018.
I don't know why we wouldn't talk about global revenue. You hop around from isolating on one market to the next market, saying the U.S. doesn't matter, saying Europe doesn't matter.
Tesla reports a total revenue number, which is global. But if you want to talk about U.S., right? Their U.S. revenues peaked in the fourth quarter of 2018. So if we're not going to talk about global,
I guess
we'll
see.
About US.
I think we'll just have to leave it at that. I think investors have to be forward-looking. We can look at the past and we can say that Tesla hasn't grown revenues for a few quarters. I would say that it's pretty difficult to grow when your factories are shut down and you can't actually ship cars and you don't have much inventory. You have 7 to 8 weeks less inventory than other automakers. I think it's pretty difficult to sell cars that you don't have. So I think that should be a consideration when we're talking about revenue. But as you said, we need to. Tesla needs to grow from here. They need to improve their profitability, and I think that's going to happen. You don't. So I guess we'll end up seeing what the next year brings. To me, it's not fair to say that the growth story is over and then also project for growth. You can say that historically there's a period of time here that Tesla didn't grow revenue. That's accurate. Yeah, but you can't say that going forward that there's no growth. That comment is also,
in our view, that comment's misleading because they had one car factory, now they have 2. They had 3 models, now they have 4.
So what happens when they have 5?
They're going to sell. Hold on. To assume they're going to sell something
four or 5 factories
out of their new factory. Oh, hear me out. To assume they're going to sell something incrementally out of their new factory, and that new car is going to sell something incrementally, that's going to be growth. That doesn't mean it's good growth.
That's the whole point.
That doesn't mean that they're gaining market share. It just means that they have a new facility and a new model, right? The key is market share, right? You can argue pandemic. You can argue their factories were closed. Everybody was affected the same. So if Tesla is truly, their supply constrained and there's unlimited demand for their cars, then their market share should be growing, and it's not. It's imploding in Europe. And when we get the data from the U.S. as these new cars come in, we'll see what happens. The market share in China has been consistently below 10%. Consistently, it went from 10 to 3 to 10 to 3, but they're not gaining share there either. We have that data. So their
market share in China is like 15-20% this year, up from like 6% last year.
I'm sorry?
The market share numbers that I have from China, I believe 19% through January to June, is Tesla's share of the EV market in China, up from about 6% last year. Those are the numbers that I have.
Yeah, your numbers are wrong.
Okay.
I'll shoot
Send
you
me the accurate numbers then.
I have those numbers. I'm looking at them right now. I'll shoot you those numbers when we get off this call. All that I would ask is when I shoot you this stuff, when you have the bulls on, in fairness to me, since you're giving me the hard questions, ask them some of these questions. Ask them, why is the European share falling? Why is their China market share not growing? Why haven't their revenues grown? How is this hyper growth? How is this disruptive when it's only 1.7% of auto sales? I'd like to know their answers to those questions. Where are the million robo-taxis that Elon Musk said were going to be on the road this year that he used to raise $1 billion last year? So how can we believe what he's going to say at Battery Day? How can we take anything he says with 100% certainty when just last year Autonomy Day was used as a means to raise money and they haven't hit those targets? I think some of these questions not only need to be asked of the bulls, but you need to ask the company. I think it's fair to ask them some of these questions.
Sure. I mean, I don't have unlimited access to ask them questions, but I think some of these points are valid and should be asked. But Tesla has hit some of their targets too. Back in I think 2013, they said that they were going to ship 500,000 vehicles in 2020. They've done that. They did increase that target back when the Model 3 was launching.
Well, no, they haven't done that. They haven't done that. We don't know what they're going to ship.
Well, you're guiding for 494.
But again, that's my guide. I could be wrong, right? You can't say they've already hit a target that we don't know the numbers yet. You can't say they're going to do 500,000 cars this year.
That's fine. That's a fair point. We can come back to that in January. That's totally fair. But I think the point is that Tesla has made significant progress.
What I would argue is they can do 500,000 cars if they cut the price of their cars by 10,000 and they lose $500 million in their auto business, right? I mean, again, like at a certain price, price elasticity. There's unlimited demand for Tesla cars, right? They cut the price of the car to $10. I go out and get one. So my point is, you have to look at profitability. That's very important. Can't just look at volumes, right? Because they're cutting prices aggressively. So we got to look at profitability.
Sure. Yeah, I wouldn't argue that. I think this quarter
in their auto business, look at profit in their auto business, not including these one-time credit sales and them selling FSD technology that doesn't exist to people. It doesn't exist in our opinion. We don't believe FSD exists today. But
sure,
listen, I appreciate you having me on, man. This was fun.
All right, yeah. Hopefully we can do it again. Maybe sometime in January when we get the full year results.
I'd love to debate like one of the bulls, like a Jim Cramer or maybe a Phil LeBeau or one of these guys who are constantly on TV, pumping the stock without numbers in our view behind them. I'd love to get into the numbers with them. I'm sure they look at the numbers, so I'd love to get into the numbers with them and really get their views on a company that's trading at 1,000 times next year's earnings, that saw revenues peak in the fourth quarter of 2018. I'd like to get their views on that.
Sure. Yeah, maybe we can make something like that happen.
Hey, thanks for having me, man. This was great.
Thanks, Gordon. Talk to you later.
All right, take care.
Bye.